Welcome to the lecture on performance measures. So, in this lecture we are going to talk about the performance measures with respect to the mutual funds. So, we discussed about the evaluation mechanism for the mutual funds, how they are valued, how their valuation is carried out. Now, there are certain performance measures by which we can assess their effectiveness, their usefulness. So, among them the first one is the expense ratio. So, that is also denoted by ER. Now, this is basically useful for comparing the cost of investing between two or more funds. So, basically you require to invest, and for that some cost is involved, and based upon the assets of the two fund, we basically calculate this. So, it reflects a fund's operating expenses relative to the average asset throughout the year. So, what we do that when we have to talk about the expense ratio. So, this is defined as so this is denoted by ER, and ER is defined as the expenses which occur, and then that will be multiplied by 1 by average of the assets. So, A1 plus A2 by 2. So, average of the net asset that will be in the denominator, and then your expenses will be the operating expenses they are basically. So, that will be at the numerator. So, and the net average asset will be at the denominator. So, this ratio is normally known as the expense ratio, and it is normally expressed in terms of the percentage. So, for example, if suppose for any mutual fund company, it is showing that its total asset at the start of the year. So, suppose for a mutual fund company at the start of the year its assets, so that it will be given. So, at the start of the year the asset is it is told to be of the value of 3950.50, and then at the end of the year. So, at the end of the year it is estimated to be 3873 and 150, so that is dollar. So, suppose, and also if you are told that the operating expenses. So, if the operating expenses have reached something of the order of suppose $35,000, in that case you can calculate the expense ratio, and expense ratio will be 35,000 divided by the average of these two. So, it will be 3950,000 plus 3873,150 and divided by 2. So, that way you calculate the expense ratio, it will be coming something close to 0.009, or that will be 9%. So, this will be 0.9%. So, that way we calculate these values. I think it will be 0.09. So, you can calculate that. So, it will be 35 by 3950. So, it will be, if you do the average, 35 by 0.3950. So, it will be something close to 0.009. So, it will be 0.9%, fine. So, that will be you can say that it will be is a 0.9% of is the expense ratio. Now, if the expense ratio is more, then it is going to take away from the investment. So, that is what the meaning is, and normally the expense ratios values it varies between 0.4 to 1.5%. So, this is the usual range in which this expense ratio should fall, and if it is higher, in that case it will be taking that return from the investment. So, your return will be smaller. Then the next performance measure, which is an index of measuring that how good you will be able to get the return. So, that will be total investment expense, and that is TIE. Now, this total investment expense, it is nothing but the expense ratio plus the load expenses adjusted to the holding period. So, you also take into account the load expenses in that. So, that once that is considered, then it becomes the total investment expense, because the load charges are there anyway and they are to be taken into account. So, the expression for the total investment expense, so that is total investment expense, that is TIE, this is denoted by TIE. So, this is basically calculated as 1 by n of LF plus LB. So, that is this is 1 by n LF plus LB. So, that will be the n will be year, and then you have, so you are holding for n years, and then plus you have ER. So, this is how it is defined, that is load expenses will be adjusted for the holding period, that is n. So, that will be your total investment expense. So, for example, if company is it is said that the front end load. So, if the front end load, so that is of mutual fund. So, that is given as 4%, and back end load, suppose that back end load is given as the 3.5%, and also the fund is held for 3 years. Fund is held for 3 years. So, in that case you calculate this total investment expense. So, if you calculate the total investment expense, now if you take this total investment expense in this case, so your value was for the earlier problem itself. So, it will be 1 by 3. So, it was kept for 3 years, and then you have 4 plus 3.5. So, it will be basically 2.5, and then you have 0.009. So, that way you can calculate these values, and it will be 2.5 and then it will be 0.9. So, basically this is also to be taken in the terms of percentage. So, it will be 0.9%. So, basically this will be 0.9%, and this is 2.5%. So, this will become 3.4%. So, that is how you calculate these total investment expense. Then the next performance measure is the reward to variability ratio, that is RVR. Now, this will performance measure will assess the mutual fund beyond the risk free return for every unit of total risk that may be faced by the fund. So, basically you are assessing that fund beyond that risk free return, and the risk free return may be something very standard one, maybe for the municipality, or from the a special type of specific government bonds. So, they offer you the risk free return. So, based on that you are calculating these this performance measure, that is reward to variability ratio, because it will talk about how much varying it is, how much the variability it has. So, what you do here is that you are getting the this return, and you are having so return on certain fund, and then you are return on the so the risk free return value, and that is basically divided by the standard deviation of the return on the jth fund. So, that way we calculate this performance measure. So, your risk to variability ratio, that is RVR, and this RVR is basically computed as 1 by sigma j. So, that is the standard deviation for the jth unit, and jth fund, and then we are finding that R jt minus RFT. So, that is return for the jth fund for time t. So, RJT will be the return for the jth fund for time t, and the RFT, that is your risk free return, that is return on a risk free asset for time t. So, that is return on risk free asset. Okay. So, that is FT for time t. So, what happens that you are going to take their difference, and then it is divided by the standard deviation of the jth fund. So, that way you calculate this risk to variability ratio. So, you can understand that by referring to a certain example. Suppose a person has you have a mutual fund which is giving you return was, so for a mutual fund, suppose the return was 9%. So, return was 9%. Then also you are given that risk free return is 5%, and if the standard deviation in that time, and if the standard deviation of returns during that time. So, in the same time, so that is given as suppose 18.53. So, in that case you can find the risk free return. So, that is risk to variability ratio, and that will be 1 by 0.85, 1.53, that is basically in terms of percentage. So, you will divide it with this 0.09 minus 0.05. So, that will be coming out to be something close to 21.6%. So, it means that the fund is providing 21.6% return beyond the risk free rate. That is what it means, that beyond the risk free rate this fund is giving you the 21.6% return. So, that is what the meaning of the risk to variability ratio it is. Then there is a term that is, so you can find the rate of return on the fund. So, further if you have to calculate the rate of return of the fund, in that case you can calculate the fund rate of return. So, that will be R. So, R will be S by IF, and then you have to have the values of delta P plus D plus G. So, in this case the R is return on the rate of return on mutual funds. Then you have S is the number of shares which is owned. So, S is number of shares owned, and IF is the amount invested in funds. So, this is amount invested in funds, and the value delta P is the change in price of the fund. So, that is delta P, and D is the dividend which is received per share. So, this is dividend received per share, and G is the basically capital gain per share. So what you see that we are talking about all the gains which we are getting. So you have whatever you have invested, that is the investment, that is IF, that is amount invested. Then certainly you have the number of shares, so that is there. Then depending upon the number of shares, you are going to get something, how the changes are there. So if the delta P, that is change in the price of the fund, that may be positive or negative. So based on that, you will have all these values. So that will be multiplied with the number of shares. Similarly, dividend received per share, and that will be multiplied with the number of shares, and same way the capital gain per share, and that will be multiplied with the number of share. So that will be talking about what is the gain or overall gain, and then that will be divided with the investment amount which you have invested, and this value, amount invested in funds. So that will be giving you the value of the rate of return. So you can use even this formula for a certain example. Suppose you have invested, so suppose you have invested dollar 2500 in purchasing 200,000 shares. So in purchasing 200 shares basically, and then it is at the rate of $12.50 a share. So that is the rate, and after a year, suppose the price has increased. So after a year, the price increased to $13.70 say, and company got say 30 cents in dividends. So that is the dividend, the gain from the dividend, and 45 cents in capital gain. So this I mean, if you have these values, then in that case what will be the rate of return. So you can calculate these values directly by putting simply the values into the formula. So rate of return will be basically, you can calculate as S by IF. So S is the number of shares owned, and we know that we are purchasing 200 number of shares. So it will be 200 divided by investment. So how much we have invested? So we have invested $2,500. Then we are keeping delta P, that is your change in price, and if you look at the change in price from 12.50, it is going to 13.70. So change is 1.2. So it will be 1.2. Then you have the dividend price. So dividend price will be 30 cents. So it will be 0.30, and similarly capital gain is 0.45. So this way you can calculate these values. So it will be 1.95. So it will be something like 400 by 2500. So 1 by 6 or so. So it's coming close to 15.65%. So this way you can calculate the rate of return. Now another thing which is important to be calculated will be the standard deviation, and the standard deviation can be calculated based on, we know that standard deviation is calculated based on summation of x minus x bar, that is square by n minus 1. So so this is xi. So you have xi is the return for period t, and x bar, it is the mean return, and n is the number of periods. So, that way. So, it is basically standard deviation is normally used to measure the extent of risk, in when we talk about the flow of returns. In that case, if being more, it will be talking about more risk. So, it will be more riskier, and having less value, it means the risk is less. So, that is how these standard deviation values are calculated. So, if suppose you have you track down the 7-year returns for a particular specific mutual fund, and what you find that for 7 years a mutual fund company has registered, or it has reported. So, it company has reported following returns. So, following return values. So, suppose the values are suppose 5, then 3, so 5, this is 5, then 5 3 by 4, then 6.5, suppose say 6%, then 7 1 by 3%, and 8, and then you have 9.5. So, if that is the type of the pattern in which the investment rate of return that is shown for any mutual fund company. So, suppose we have to find the standard deviation. In that case, what you have to do is you have to first find the mean return. So, you have to find the mean return, you can calculate them. So, mean return will be calculated, and mean return will be like 5 plus 5 3 by 4, that is 5.75 plus 6.5 plus 6 plus 7 1 by 3 plus 8 plus 9.5, and this will be divided by 7. So, this comes out to be something close to 6.78. Then what you will do is you will find the summation of this value. So, sigma will be basically under root, and then you will be doing that 6.78 minus 5 square, similarly 6.78 minus 5 3 by 4 square. So, like that we are going to have the difference and its square. So, it will be 6.78 minus 5 square plus 6.78 minus 5.75 square. Then so that way it will go, and lastly it will go 6.78 minus 9.5 square. So, this way, and then also divided by n minus 1. So, you have n entries, that is 7. So, you are going to divide it by 6. So, that way you are measuring the standard deviation, and in this case you can find the standard deviation values by working on this. So, you will get these standard deviation from this formula. So, that if you do the computation, this summation comes out to be 14.06. So, 14.06 divided by 6. So, it will be something like 2.3 and 4 or so. So, if you take its under root, it will be 1.53. So, 1.53 is the standard deviation. Now, many a times you have so since the standard deviation is smaller, so you have lower amount of risk involved, low level of risk in this case. Now, many a times when we talk about the portfolio investment, so in that you have a lot of diversification, you have degree of diversification of the funds in the investor's portfolio. So, what we do is that we find the relation coefficient, correlation coefficient, and Pearson has given this Pearson correlation coefficient, that is correlation index, and this is about the degree of diversification, that will measure the degree of diversification for the investor's portfolio. So, in that there is another performance measure, and that is Pearson's correlation coefficient. And this correlation coefficient that is denoted by Rp, and this Rp is basically given as 1 by sigma I sigma j, and then that will be multiplied with this is summation of Ri minus Ri bar, and then that will be multiplied with Rj minus Rj bar. So, you have returns on these ith and jth fund, and then you will be dividing that with n minus 1. So, that will be talking about the Pearson's correlation coefficient. In this case, sigma I and sigma j, these are the standard deviation of the returns for fund I and j, and Ri and Rj. So, they are the return values. So, Ri and Rj are a series of returns of fund I and j, and apart from that you have n is the number of return periods. So, what we do in this case is you have once you have the for the two returns the so the return values are given, then you have to calculate the standard deviation values, and you will be calculating the Ri minus Ri prime. Similarly, you will be calculating the Rj minus Rj prime, and based on that and then with the so if you have 5 readings, you will be dividing with 4, and you are going to calculate the standard deviation of the 2 readings. So, you have 2 funds. So, for the 2 funds you will be calculating the standard deviation, and you are going to compute the value of Pearson correlation coefficient. You also compute the correlation coefficient when you have when we talked about the random variables. So, in that when the correlation coefficient values, so that will be normally varying between -1 to +1. So, when it is -1, it is said to be extremely negatively correlated, and if it is towards +1, it is the extremely positively correlated, and if it is 0, then they are said to be independent. So, it all depends, it will tell you that how these returns vary. If for fund I in a particular year the some return value is there, and if Ij has some other return value, and the way they are changing every year, if one is changing and the second is also changing proportionately in the if one is increasing, another is also increasing, one is decreasing, another is also decreasing, then it is positively correlated, and if one is increasing and second is decreasing, that is negatively correlated. And when we talk about the diversification of portfolios, diversification of assets, in those cases the negative correlation is more preferred. So, that is what are the performance measures we normally discuss about. Now, another thing which is important when we talk about these investments. So, you have the risk, and we know that you have the 2 types of risk, systematic risk and the unsystematic risk. Now, we talk about the systematic risk, and here you normally talk about a parameter that is beta, and this is also known as, so systematic risk also known as the market risk or undiversified risk, and this refers to the unavoidable type and level of risk which is inherent in the nature of free market. So, you cannot control it, and it's tied inextricably to its fluctuations. So, there are certain so risk has basically 2 components. If you talk about the risk, so risk, if you look at the total risk varies like this, and in this part it is this part will be your risk, which is basically the fixed one on which you do not have any control, and this component of risk is basically the component where you can control, and this control can be done using these diversifications. You can have the investment of fund in the different sectors, you can have different types of shares you can purchase, and that way when you combine the assets, you will see that their risk is decreasing. So, this risk is in this, so risk will be decreasing by by the diversification of fund, and but this component is always fixed. So, this part is the systematic risk part, that is what we are discussing. So, this is this type of risk cannot be eliminated or reduced by the usual remedy of diversification of funds. By diversification of funds, we can do something in the upper part. So, that is what we discussed. This part will be in our control, but this part is not in the control, because this is governed by many things like war, political situations, how the market is moving. So, all these local disturbances on which you do not have any control. So, that is there, and the systematic risk for a specified fund return such as RI, it is measured by beta, that is beta I, and it is obtained by dividing the covariance between RI and market return RM by the variance of market return. So, you will be finding the covariance between RI and return RM. So, that there is a formula for covariance, in that we know that we are calculating the RI and RI values and then RI mean values. So, that way it will be multiplied and then multiplied with the probabilities, and then it is you are getting the covariance values, and then it is divided by the variance of the market return. So, if you do that, you will be getting the value of the systematic risk. So, this we can do by practicing on certain questions when we deal with them in the coming lectures. Thank you very much.